Welcome to the deep dive. If you've ever watched your portfolio bounce wildly after a seemingly random central bank meeting or maybe a surprise GDP announcement, you know that the big picture matters. We often hear about focusing on the micro, a single company's fundamentals, the value of one house. But today, we are going completely macro. Our mission here is to quickly distill what we're calling the macro wealth nexus. We've got this stack of research, and we're trying to figure out how the biggest global drivers, things like economic growth, inflation, policy, and market sentiment, are actually dictating your individual wealth strategy. We want you to stop just reacting to market shifts and, well, maybe start anticipating them.
Yeah, you've really hit on the core issue there. That link between the macro environment and personal wealth, it's inseparable. Think of these big economic trends not just as like background noise, but more like tectonic plates.
Okay.
They fundamentally influence how quickly households build wealth and how well they hang on to it. They can either gently nudge your investment plans
Yeah,
forward
completely derail them.
or completely upend them overnight, as we've definitely seen happen.
And the main mechanism for this connection, it seems to be all about psychology and confidence. It's called the wealth effect, right?
It is, and it's fascinating because it's where human emotion really meets economic reality.
Mm-hmm.
Put simply, the wealth effect describes what happens when households see the value of their main assets. Think investment accounts, stocks, and really importantly, their homes going up.
Right.
They just feel wealthier, and that feeling, well, it usually translates pretty directly into more spending and maybe less saving.
Which fuels the economy.
Exactly. It drives economic expansion, hiring, the whole cycle.
But the reverse side is where it gets pretty devastating. When those asset prices start to tumble, that feeling of wealth just evaporates.
Instantly.
Households pull back, they stop spending, they cut back on borrowing, and this creates a really severe damping effect on growth overall. It's like a confidence feedback loop that can just freeze an entire economy.
And we have some really concrete historical examples of both sides of this. I mean, look at the positive wealth effect between, say, 2003 and 2007. Asset prices were rising steadily.
Confidence was high.
Confidence soared. Households were spending. Investors felt secure enough to take on more risk, maybe even increasing amounts of risk.
Okay, and the flip side.
Well, contrast that with the huge negative wealth effect during the 2008-2009 global financial crisis, when the main source of U.S. household wealth, which was home values, collapsed.
Yeah.
Spending just dropped off a cliff. Investors ran from anything risky. Businesses basically stopped hiring. That decline created this chilling effect that spread way beyond just the housing market.
That chilling effect is key, isn't it? It means these huge macro forces really cascade all the way down to corporate boardrooms and then ultimately to every single micro investor. The question is, how fast does that confidence gap translate into actual corporate decisions?
Almost instantly, it seems. We know economic growth isn't just some backdrop. It's like an active ingredient in corporate decision-making. There's research indicating that just a one-unit jump in overall economic growth can boost corporate investment. So that's spending on new equipment, R&D, expansion, by a pretty robust 2.6%.
Wow, 2.6%.
Yeah. The macro environment really dictates the corporate appetite for taking risks.
Okay, that brings us neatly to the biggest drivers you need to track, the 5 macroeconomic levers. These are the levers that basically set the whole context for every investment decision you make. We're talking interest rates, inflation, economic growth, fiscal policy, and global trade.
Exactly. They're all intertwined, of course, but tracking them individually gives you a clearer playbook. Let's start with lever number 1, interest rates. These are generally controlled by central banks, and they represent the price of credit.
Right, so when rates rise, loans suddenly get more expensive for everyone, from huge corporations issuing bonds to, you trying to buy a house. Spending tends to decrease, and that naturally puts a drag on asset prices pretty much across the board. What's really fascinating is seeing the hard data on how much this actually affects risk-taking behavior.
Precisely. We see a really strong inverse relationship between interest rates and, say, entrepreneurial activity. The data suggests a 1% increase in interest rates correlates pretty significantly with a decline in things like IPOs and write-offs. High rates just make everything harder.
Uh-huh.
Conversely, lower rates actually make it easier for venture capital exits, mainly because the debt used in those kinds of deals becomes cheaper.
Okay, so lever number 2 is inflation. That's the speed at which prices are going up and, crucially, how fast they're eating into your purchasing power. When inflation spikes, households and businesses just have less real income to work with.
And that completely changes the investing game. High inflation often means households struggle to save, Or maybe investing in traditional cash accounts doesn't make sense anymore. Investors typically pivot towards assets that have historically hedged against inflation.
Like stocks or real assets.
Yeah, exactly. Stocks, real estate, sometimes commodities. Because fixed income, like bonds, tends to decline in real value pretty quickly. And it's interesting, certain industries, like commodities producers or businesses that can easily pass on cost increases to their customers, can actually profit in these kinds of environments.
Lever 3, economic growth or GDP. This seems like the foundation, right? Robust growth is absolutely essential for creating wealth because it means higher revenues, more jobs, increasing corporate profits, the whole positive cycle.
It really is the bedrock.
And here's where that growth becomes tangible for investors. Even a modest, say 1% bump in GDP can increase things like trade sales, IPOs, and management buyouts, MBOs, by somewhere between 0.6% to 0.9%.
And an MBO is just when a company's management team buys out the existing shareholders, essentially.
Right, so that growth directly translates into better asset performance across the whole spectrum.
Okay, lever 4 is fiscal policy. This is how the government uses spending and taxation to try and steer the economy. Fiscal stimulus, like government spending projects or maybe targeted tax cuts, can certainly speed up recoveries. But, and we need to be impartial here, the general consensus is that too much stimulus can easily stoke inflation, while severe austerity measures, on the other hand, often slow growth down.
So it sounds like fiscal policy is the lever that determines not just maybe the rate of growth, but also who benefits within an economy.
It absolutely structures where wealth tends to get distributed and accumulated, yeah.
Okay, finally, lever 5, global trade. This covers everything from trade deals and tariffs to international political risk, all of which directly influence asset prices and how capital flows around the world. Geopolitical tension rarely stays contained, does it? It seems to bleed directly into domestic markets.
It really does. But the influence isn't always straightforwardly negative. We found this intriguing sort of counterintuitive data point about political risk.
Oh,
Yeah, a 1% increase in global political risk can sometimes actually increase trade sales, IPOs, and MBOs by more than 1.6% to 2.7%.
how does that work?
Well, while extreme volatility definitely adds complexity, it can also force capital to move quickly. Money might shift rapidly to areas perceived as safer, or maybe where new opportunities are suddenly opening up. This can lead to some dynamic, high-value transactions, even amidst uncertainty.
Okay, so we've established these 5 levers are the context. If you want to anticipate shifts, not just react, you need to understand how these levers actually impact your portfolio or assets.
Exactly. And connecting this back to the bigger picture, these 5 levers really set the stage for how different asset classes perform. And this is precisely why diversification is so critical.
Right.
You absolutely need assets that react differently to the same economic stimulus. That's how you smooth out the inevitable volatility these big macro shifts cause.
All right, let's walk through a quick asset class playbook based on sensitivity. First up, equities or stocks. They seem to respond really quickly and negatively to rising interest rates, but they love earnings potential.
Which is heavily driven by consumer spending, as we noted.
Exactly. So if people stop spending because rates are too high or they're worried, shares get dinged hard.
Then you have fixed income, or bonds. They are the ultimate interest rate and inflation play, aren't they? And the relationship to price is always inverse.
Okay.
They are often your essential defensive component. When the growth outlook really tanks, capital often rushes into bonds seeking safety, which pushes their prices higher. We saw this defensive utility proven dramatically during the market shocks back in March 2020.
Yeah, I remember that.
And what's fascinating is just how precisely bonds track macro news. Some research shows that economic report surprises account for more than a third of the daily variation in U.S. bond prices each quarter.
A third. Wow, that's incredibly sensitive.
It really shows how tuned in that asset class is to macro announcements.
Okay, real estate. Heavily boosted by economic expansion and employment, right? More jobs mean more demand for housing and commercial space.
Definitely.
However, it gets cooled pretty rapidly by higher interest rates, mainly because soaring mortgage costs just crush affordability and demand. This is where that wealth effect connection really comes full circle, especially with residential property. Rising home values support broader economic confidence.
Good point. And rounding out the main asset classes are commodities. things like gold, silver, oil. They tend to rally when inflation spikes or global uncertainty rises. They act as those traditional shelters against losing purchasing power.
So the ultimate takeaway here seems to be the power of mixing these approaches. You mentioned diversification. Drive that home with this detail you found. During one recent year, U.S. equities dropped, what is it,
A
32%?
dramatic 32%, yeah.
Yeah.
But in that same period, traditional safe haven assets like gold and inflation-linked commodities actually jumped 50%.
50%.
It just shows you absolutely need assets that zig when others zag to survive a full macro cycle.
Okay, now let's shift focus a bit to the maybe squishier part of the equation, investor psychology. Macroeconomic indicators, GDP releases, inflation stats, employment numbers, they directly influence investor sentiment, don't they? Good news pushes prices up. Weak data sparks fear.
Absolutely. And this creates a powerful and often, let's be honest, irrational feedback loop. We know that prices can swing far more wildly than the underlying fundamentals might seem to justify, simply because of mass sentiment. Investors, even the really sophisticated institutional ones, are highly susceptible to behavioral biases.
Yeah, those biases, they really trip people up repeatedly.
They do. The most common ones include things like loss aversion. Psychologically, we feel the pain of a loss about twice as strongly as the pleasure of an equivalent gain. Then there's recency bias, overreacting to whatever just happened in the news, and hurting, just blindly following the crowd, the perceived market consensus.
That loss aversion is brutal. That's what makes people sell low and buy high, isn't it? Even when they intellectually know better.
Exactly. And the consequence of these behaviors is measurable. Studies suggest these biases can lead investors to underperform their own chosen funds by roughly a fifth over a 10-year period.
A fifth, just from bad timing and emotional reactions.
Pretty much. And when you introduce major macroeconomic stress like a deep recession or runaway inflation, it just amplifies that fear, leading to even faster, worse decisions.
So what's the antidote? The research suggests setting up guardrails. Things like implementing automatic investing schedules, committing to only checking your portfolio at scheduled times, maybe quarterly.
Documenting your rationale, too.
Right, writing down why you made a major decision before you make it. These simple steps can help mitigate that stress and prevent macro events from triggering purely emotional, often damaging mistakes.
This naturally leads us to think about the future, doesn't it? The global economic structure feels like it's shifting under our feet. Successful investors have to adapt. We're seeing maybe three emerging macro risks that really demand attention right now: deglobalization, climate economics, and digital currencies.
Okay, let's touch on those briefly. Deglobalization first. If countries pull back from global supply chains and trade pacts, what does that mean for investors?
Well, it likely reduces capital flows, increases volatility, and makes domestic markets much more vulnerable to purely local shocks. Investors might need to shift focus from, say, global supply chain efficiency towards companies that benefit primarily from local demand.
Okay. Next, climate economics. This seems huge.
It is. It introduces entirely new types of asset risks. Think about the potential decline in value for coastal properties due to rising sea levels, for example. And it's fundamentally compelling investors towards sustainable investing. We're seeing a huge boom in ESG, environmental, social governance funds, as investors rethink company valuations based on climate risk, potential carbon taxes, evolving regulations.
Right, ESG is everywhere now. And finally, digital currencies. Bitcoin, stablecoins, maybe central bank digital currencies down the line.
Yeah, these assets are already transforming how capital flows, and they might fundamentally change how wealth is distributed. What's crucial for our discussion today is that these digital assets might not respond as predictably to traditional macro trends like interest rate changes or inflation prints as stocks or bonds do.
So, a whole new learning curve.
Exactly. A new learning curve for investors trying to find reliable signals, especially for things like inflation.
Okay, let's try to wrap this up. To summarize our deep dive today.
I'd say savvy investors simplify the complexity. They do this by actively monitoring those 5 key macroeconomic indicators we discussed, trying to detect emerging trends, and using strategic shifts. Often this involves combining hard data with human intuition, sometimes called a quantum mental approach, to align their strategy with what's actually happening in the real world. Flexibility is absolutely essential because rigid, set-it-and-forget-it plans will inevitably fall short when major macro shifts occur.
So, the advice for you, the listener. Keep learning, stay open to these new ideas and technologies like digital assets and ESG, and use global diversification strategically. Use it to offset some of the risks from purely local macroeconomic events. That seems to be the way to stay on track in a world that's, well, always shifting.
And maybe we can leave you with this final provocative thought to mull over. The connection between traditional macro trends and asset prices, it definitely still exists. But the trajectory, the way it plays out, feels murkier now, partly due to the rise of these new digital assets. So the question becomes, what will be the first digital asset to clearly signal a major global inflationary shift? And perhaps more importantly, will we even recognize that signal when it happens?